I'm Jonas, and I'm here presenting a kind of a real-world problem that we are facing with one of our clients, and trying to kind of broaden that a bit. And Benita and I will be trying to convert this kind of use case into some papers. So my ask is really to, if you as a conference have some good ideas that, or kind of see whether some of this resonates with you, because I think the discussions that we have had has been very much on the kind of how do we trust. Frank's presentation yesterday was about digital trust, and we have been talking about how can we utilize Chat GPT. What I'm proposing here and what we're talking about is more of an infrastructure where we can rely on, make sure that we actually have the right infrastructure to go on. But let's see how it goes, and hopefully you will help me go through it. And if you have any questions, maybe you could remove that talking host up there, because people can scan that QR code if you want to add any comments into our Menti. So right now, we are working on a concept that we call Radical Digital Triplets. And I will explain why we have that. But as of now, the focus is on portfolio companies. So let's say that you're a large fund and you would like to invest in green projects. So that being windmill, offshore, onshore, it could be solar panels that you would like to. And many of our clients, they are maybe have been heavy in oil, and now they want kind of refocus into more green assets. So what we are seeing is that the problems around this transition is that there's really no IT infrastructure that support the kind of expansion with the combination of the ESG reporting coming out of the EU and the rest of the world. So how do we do that? And if you look into the US, so there's a kind of created this Inflation Reduction Act. But the problem is that if you want to create a new project, you need to prove that this is truly a green project in order to get that deduction and that tax refund. So there are problems around how to actually ensure and get the information in the right manner. And especially the kind of last one here, I have written around the ESG requirements for an inter-organizational focus, because normally continuous auditing and the other schemes and what have been presented has been very intra-organizational focus. So, and that's also coming from an accounting focus and an accounting firm. It's always about the organization itself and not so much about the kind of collaboration between organizations, between actors. And the reason for that is typically because who do you sell to? It's hard to sell to no one who really owns that problem. So that's what we're trying to do, and our solution here. And I really like the previous methodology of the design science research. I haven't put a lot of kind of methodology behind, but this is very much a design science research project. So I'm going to talk a bit about these radical digital triplets and see how that resonates. So if we go through what the problem landscape looks like today. So this is a portfolio company. It resides of a resource pool. So that could be any large number of employees, IP, so on and so forth. There are also a lot of ventures, which is the kind of subsidiaries of this kind of main company. It has a lot of legal entities, and then it might also have a lot of assets in operation. What they typically do is that they find startups and what is called platform companies, and then they do some kind of investment in those. So which means that so let's say that a company wants to do a project in Brazil, then they go to the Brazilian market, find startups that are building new assets, in that market, and then kind of say, okay, so we would like to maybe reserve some investment in those companies. So you see here P1, 2, 3, 4, 5, 6, 7. That's projects, so that a new solar park or a new windmill, right? But at the beginning, even though that you have a lot of cash in the kind of mother company, you might only want to reserve, let's say, 10% of that because of your risk profile. So at some point in time, there needs to go some information back, either in forms of report or dividend as a kind of cashback on your investment. However, the problem is that if you're as a large company, you don't want to force some kind of rigorous reporting standard down onto those tiny projects, because that would kind of ruin the innovation and the entire problem. However, you also need to be SOX compliant and all the other compliances that you need to consider. So there's a dilemma here that you want to find the projects that are interesting. However, you don't want to enforce that rigor into it. But on the other hand, you need to be compliant with the law. So how do you deal with that? Further, when some of these projects go into kind of more matured state, you have assets in development, and you can see here from the legend that the ownership stake also typically changes. And then over time, you hopefully have some assets in operations that you can help with your own resources. And then over time, you also has the possibility to divest some of the assets. These are the actors that we kind of see are the interesting parties. So the government institutions, the financial and insurance actors, the auditors, and the standards bodies. And the kind of key challenges here is that you have an ecosystem where there is a lack of data standard. There is a varying degree of transparency needs and incentives, which is quite important here. And there's no really kind of an information system interoperability standard either. Because in here, you typically have a large ERP system to manage what is happening inside of the company. However, out there, it might be another game. It might be another jurisdiction. It might be another. And so how do you deal with that? So that's the kind of problem landscape that we are facing, that our clients are facing. How do we come up with a solution to actually solve some of these things? So what we have tried to do is that we have created a couple of design principles. So one is that we want to create digital twin as the kind of core finance process. And we would like to have a focus on automation, real-time transparency, and then the two last ones that are quite interesting is the asset lifecycle focus. So instead of only focusing on what's happening right now when I'm in control, we need to focus on the life cycle for the entire asset, which also means after the divestment. And then in the last one here is the collaborative mindset. So maybe we need to collaborate a bit more also with our competitors. So a bit of a kind of housekeeping here. So why do we think that digital twins here are actually important? Well, because it enables this kind of tight connection between what's happening in the analog world and have a digital representation of that in order for us to kind of simulate what's going on. And then we create 3 types of digital twins. The operational digital twin, which is at the kind of asset level, but it needs to be very granular. There was also a comment here that most ERP systems and more data that we collect is very aggregated. We need this to be on a transactional level, and we actually have a prototype in our small garage in Copenhagen where we have the inverter of a solar panel where we actually collect real-time data from, because it needs to be on a very granular level. And then we have a financial digital twin, and I don't know whether that exists in the literature. Because this is actually on the income statement. So on every asset, we would like to have an income statement, and ultimately we could also have a P&L, because if we enable every operational digital twin, let's say a windmill or a solar panel with a wallet, and let that be autonomous in order to actually optimize for their own sake, then we get close to actually being able to create a P&L on that level. And then lastly, what we can then draw out is the kind of ESG digital twin. So what we imagine is that we have the life cycle of the asset, so the inception and creation, the operations, and the diversity, the carve out, and we see that the capabilities for that is something like this. Tokenization, contracts, ownership, blah blah blah. There's a lot of things that I can go through, but in essence, these are the capabilities that we kind of see that we need in order to have this infrastructure for actually this trustless infrastructure for actually doing that. And especially one of the interesting things here is the digital ownership transfer. So if you want to transfer a windmill farm to the other ones, it's like when you buy a used car, right? You don't really know how the previous owner has actually run the car. You would like to see if it has been in the garage, how much mileage that it really has done. But how do we have an infrastructure that actually secures that these informations are actually collected in a truthful way? Then it wasn't tampered, and that the kind of guy that I bought this from was not this kind of shady guy down on the corner. Of course, it's another game when we have windmill parks, but the kind of analog here is the same. So what we try to do is that we propose an infrastructure where we can have two things. It's a distributed ledger technology, and it needs to be a public one, okay? Because the private ones end up with the same problems as the SAPs and another private-owned platform, because who do you really trust? So, and there are two key features. There is the immutability of data, and then this kind of shared logic execution. So how can we actually utilize smart contracts to actually extend the company processes into an ecosystem area to actually extend these automation things? So what we have kind of designed here is that if you can remember the projects in the top of the corner, they're all small companies, so they all have their own ERP system. And what we do is that we actually say, okay, fair enough, you don't need to comply with some kind of standard from the big firm. However, we need to make sure that the timestamping of your data is done on a daily basis. What we can then do is that we can say, and you don't need to share those data with the main company before the due diligence phase. We can actually say that when the large company wants to acquire, they can say, okay, now we want to see what has happened in the past. And then the question becomes, how do I then trust what's happened in the past? But then by using the timestamps and the hash functions, we can actually compare the data that they provide in the due diligence phase with the actual operational data from the past. So, and what we then do is they say, okay, fair enough, that if you don't want to impose a standard of actually exchanging information, we have also built some kind of AI-based conversion of the kind of ledger, the general ledgers from the small companies into this ERP core system of the large company in order to kind of make that transition even more. And then you can see it becomes easier for the ERP core and the kind of main company to do their financial reporting and the ESG. And of course, this is the kind of first level here, the notarization part. But as we trust the data and we know that it cannot be tampered with, the kind of use cases going forward becomes hopefully easier and more trustworthy, going back to some of the talks that we have had during this conference. So ESG reporting is one. Of course, the compliance, whether it's SOX or any other compliance mechanism, since that if we create that infrastructure that cannot be tampered with, both from the kind of project sides and the main company sides, hopefully it kind of increases the trustworthiness of that. Over time, you can of course think about, now that we are in the green space, that the production of carbon offsetting is also something that prohibited double spending of these carbon credits. I don't know if you know, but in the EU, there is something called the EU ETS, which is opening up right now. So if you're a shipping company, you need to kind of know how much carbon you emit for a certain route that you take, and then you need to buy these ETS, these European carbon credit certificates, in order to offset your kind of emission. That's going live next year. So there is a mandatory market that is coming on, and there is a voluntary market of carbon credits already. And making sure that you're not double spending, that's maybe also a way for doing that. Okay, so that was a very quick and dirty kind of introduction to the problem domain that Benita and I are working on. And what we would like to kind of ask the conference, and I think it kind of builds on many of the topics that we have been discussing over the last 2 days, is that, okay, so is this a purely kind of practical problem? Does it have any theoretical relevance? Where can we draw on good cases to two things? Of course, I would like to advise my client even better, but that's not really the reason why I'm here. The reason why I'm here is because, are there any kind of theoretical frameworks that we haven't considered? You can also see the Dye and Bassarelli paper is also referenced here with a question mark. Is the continuous auditing and monitoring, should it be extended into a more inter-organizational version, or do we already have those theoretical frameworks? I also reference Bill McCarthy and the REA on accounting ontology, because do we consider the kind of transaction between organizations rather than this double entry focused?